Hey guys, welcome back to the show. This is Capital Mindset with your hosts, Austin and Fabio. And today we're going to be looking at a subscriber request. This was frequently requested by many different subscribers. So the company's name is Discovery. And today Austin's going to be leading us and talking about the business overview, the moat that they have. And then we're going to be talking about what everyone's probably thinking about, which has to do with the merger they're doing with Time Warner and some of the implications of that, as well as the assets they'll be acquiring. And then we're going to be going into the DCF and basically buy prices that Austin and I would be considering in this company and whether or not Austin and I are actually adding this company to our portfolio. So with that being said, let's actually start off. And let's make that announcement real quick, because you and I were talking before this video, Austin, something about our subscribers, right? What were we talking about?
We were basically saying how great the quality of the comments we receive on all of our videos are, and how we're very appreciative that you guys have really come forward and just really wanted to involve yourselves with our channel and just giving us, analysis ideas and requests and et cetera and so forth.
But not only that, I
just want to say that we're very thankful for it. So
it's not only that, it's if you see some of the comments we're getting, the level of intuitiveness in some of the comments is quite high relative to what I see in other comment sections. So not only are we attracting a pool of users or a pool of individuals who really know their stuff or really seem to have this fire for learning, it's gonna be interesting going forward how the channel pans out, because if we can collect all these people and basically create this channel as a community of individuals who all are these not like-minded, but not even value, just investors, really good investors, investors who can really look at the nuances of different businesses and then kind of have thoughtful conversations in those comment sections. So anyway, that's one comment we were just talking about before filming this video, that we're actually really proud of the comments we're getting. All right, so Austin, going back to Discovery, what the people came here for. All right. What is the business overview? What do they do right now?
So basically, before even kind of just giving you the whole spiel of what they own and the IPs that they have, et cetera, so forth, it's important to note how this business makes money.
We need to understand.
And so this business makes money with they actually disclose this, in like 52% of their revenues come from advertising, 46 come from distribution itself. And now the interesting part about this is that a lot of the audience retention and the ratings and the subscribers that they have for their various and sundry IPs and shows, that's a huge catalyst towards the growth of their revenues, Fabio. And so now here's something that I actually want to show you. And this is basically the more so the IP and content breakdown of what, if you were to buy into Discover, these are the brands that they currently own. It's important to note that with a company like Discover, a lot of what they do focuses around acquiring good quality brands that the people want to see, Fabio. So as you can clearly see here, we have HGTV, the Food Network, TLC. If you've ever seen, 90 Day Fiance with Big Ed and all of them, they own this IP. They also own Animal Planet, which I used to watch when I was a kid. They own all these various IPs. And then also they're in a joint venture with the Group 9 Media. And if you've ever been on Snapchat before and have gone to the Snapchat news section, you've seen like Now This Media, the Dodo, all these other ones, like they have a joint ventureship in these things. So basically, the point that I'm getting at here, Fabio, is that we have a company here that is very, very heavily invested and diversified in all of these different IPs. And that's also important to note too. If there's any other part, before we even cover the merger with Time Warner, if there's any other part to note, that's kind of what colors or should color your perspective coming into this investment, which also helps explain why when we go to the DCF, this company is going to look so incredibly cheap, because what they're doing is they're building a cash buffer. So now, Fabio, it's kind of important to get into the moat of what Discover is. And that moat is, if you're guessing, and I'm sure the audience is probably potentially guessing this too, that moat consists of the quality and the reputation and the audience retention of their IPs. So that is exceptionally important. If they own TLC, which they own, and TLC keeps making 90 Day Fiance and all the big YouTubers keep reacting off of 90 Day Fiance, which does drive substantial business for Discover. That is a huge moat in and of itself, Fabio. Now, if they can take all of their IPs and basically turn that into what TLC has turned 90 Day Fiance into, and a huge stream of revenue for them, that's an incredible moat. However, it's also important to note too, that a lot of their competitors are also trying to do these same exact things. And that should Discovery start to kind of, not exactly sort of lose out on acquiring a lot of these big ticket brands, Fabio, that could have a substantial impact on their business too. Wouldn't you say that's probably the case?
Oh, 100%. So one thing I want to comment on is a lot of that business that we were just talking about, or a lot of those brands are kind of geared towards that very valuable suburban mom, right?
Mhm.
It's a very valuable demographic, and that's a good thing. So one thing I want to discuss, do you want to get into the merger now?
Not quite yet, because it's
What else?
also important to note the assets you're buying into if you were to invest in Discover now, because the thing is that the merger is expected to close, and I think they announced like mid of 2022, but if it doesn't end up going through, they're going to have to pay closing costs. So just for the sake of conservatism, at least right now, before we even touch the merger and everything involved with the merger, just for the sake of conservatism, if I was only buying Discover and there was no potential of a merger with Time Warner, I would want to know, well, what assets am I buying into as an owner in this business in and of itself? So now let's kind of take a look here, Fabio, at the assets we would be buying into. So as you can clearly see here, you would be buying into a lot of goodwill and then intangible assets. Now, the intangible assets make sense because these are their IPs, obviously.
Mhm.
However, the goodwill figure, and we at Capital Mindset are oftentimes very cautious about goodwill, basically. And the reasons for that is that basically with the figure of goodwill, with the asset account of goodwill, you have to effectively trust that management is on your side, Fabio. I'm not saying that management here is against the shareholders. I'm not saying that at all. What I'm saying is that by the impairment process on the income statement, that's how you can verify if management is being overzealous in their application of goodwill, which basically, in plain English, goodwill measures the future earnings potential of an acquisition that they just made. So let's say,
can I say to the audience, for example, so let's say you go on the income statement, you should see a line item. So something over here where it says goodwill impairment, or it will show up as an expense, but it's a GAAP net income expense. And it'll be a write down of goodwill. And that's what Austin's talking about. So look for that in the income statement, and that will give you the idea. So continue on.
Yes. Also, look kind of like historical trends. If you're seeing a lot of goodwill impairment, then that tells you that management is being overzealous, and that gives you a good reason not to trust goodwill. Now, I didn't exactly see that too much, Fabio, when I was going kind of through my rounds here, but just for the future, typically, at least the way that I like to invest in businesses where, as an owner, I'm owning actual legitimate tangible assets. And in my personal opinion, goodwill does not exactly satisfy those requirements. Now, I would never just simply X an investment simply because it has a lot of goodwill if there's a lot of other macro factors kind of supporting my thesis in potentially investing into this business. But that is something to really keep an eye on.
Well,
so yes,
I'll
I'll
add this for media companies. Media companies tend to have a lot of goodwill.
Mm-hmm.
So there's a reason why. So like, let's say I produce a movie, right? Well, the movie IP, that's something that maybe I didn't even acquire it, right? It's what is the future potential of that movie making me money over time, right? Will people continue to pay to watch that movie in the future? Will people keep buying that movie 20 years from now? Maybe, right? So that's all calculated somewhat in that goodwill. It's not materialized yet, it hasn't shown up yet, but that's the value of that asset for a long period of time, either like a show they produce. So for example, you can kind of think of Netflix in this way. So Netflix made Squid Game, right? And I actually had this conversation with someone who asked me, oh, I read this article and it says that Netflix only put 26 million and it's valued at, or the value that it's producing is 900 million. And then I said, well, if you read the article, the person who wrote the article didn't do a good job of explaining this either, because it's a journalist major. I'm just kidding. But but basically the company Netflix, or the finance team at Netflix, took the value of Squid Game and made projections on it in the future as to how many individuals it would attract to the platform and how many individuals it would retain because of it. So they put a value behind it, and that's what that value is. And that's actually what would go on the Goodwill on Netflix's balance sheet. And I think it was close to $1 billion. So it was close to $1 billion in projected value versus 26 million spent. So that's an example. So these companies, when they produce content, especially when they get into the streaming game, right? When they focus hard on the streaming game, a lot of this is going to be goodwill, because you're going to be producing shows that people are subscribing to regardless of the shows, right? So you're getting the action of getting money has become more separate from the actual content itself directly. So for example, I subscribe to HBO Max, and then Warner Brothers decides to make another Game of Thrones, right? That's going to show up on HBO regardless of whether I subscribed or not. But all that value of them projecting, hey, Fabio is going to subscribe to HBO Max, that projections and how long I'm going to be a consumer from them is put into their goodwill. They will measure it like that. And whether or not that materializes or not is a different question, but that's what they're going to record under GAAP as to the value of the asset, so-called like Game of Thrones and all the other stuff that they do. So I hope that kind of makes sense. It's different from like a movie. So even though a movie is similar, but a movie, for example, has the box office that's measurable, right? And so in the first couple of weeks that it's out in the box office after it's produced, you get to see that income right then and there. But the goodwill going forward on that movie is what the movie's going to make, many years down the line, right? The total residual value of that movie. And because, for example, there are people today who are still buying older movies, right? They're buying it on different platforms, like on Amazon, I'll buy a movie that's, not 20 years old. I'll buy it and they'll be on my Amazon. But that company who I bought it from, they're going to get money from that, even though they made it like 20 years ago. That's an example, right? And then they're supposed to kind of somehow project that in goodwill. So that's why we take it with a grain of salt, right, Austin? It's
exactly.
Not
and then
100%.
To really kind of add some more color to that as well, it's not all well and gone just that if management's being overzealous in their application of goodwill, because of the fact that FASB came out through GAAP, the fact that you have to impair this goodwill. So even though you might see a lot of goodwill, it might be actually a good strategy sometimes for these companies to completely legally do this, by the way, completely legally write up their goodwill and then impair it the next quarter to potentially hit specific targets or whatever. That is legal to do, by the way. It is.
It's not. So this is almost becoming like a lesson on goodwill. So these are some nuggets of knowledge for those of you that may not be. We're trying our best to help those who may not have an accounting background to follow along. But when you write down goodwill, that is not tax deductible. So some people make that mistake and they think, oh, they're writing off goodwill. That's probably going to be good for the company because they'll pay less in taxes. Not at all. It's a non-tax deduction. It's just a GAAP net income deduction, which is actually one of my gripes with GAAP net income, is that it doesn't truly reflect the actual tax implications of an event. That actually is tax accounting, which is a separate form of accounting than GAAP accounting, to make it worse, right? To make it worse. So GAAP accounting is supposed to make it easier for you as an investor to kind of understand what's going on in the business. And there's some truth to that, but then there's some things it misses. And what Austin is saying is technically, earnings management is technically as an action supposed to be illegal, but that's one way of earnings management, right? Tomato, right? Call it whatever you want. That's earnings management.
Yeah. Now I'm also not saying Discovery's doing that. No, I'm not saying that. This is just like an aside, kind of going off track, more so explaining goodwill, which if you decide to invest into this business, you are now an owner. You have claim to that asset. So that's kind of the other interesting part too, that really kind of rests on the balance of just sort of financial accounting as a whole, is that even sometimes myself, and I see this all the time on YouTube, people are incredibly sometimes too trusting of the numbers. And it's important to have a healthy amount of skepticism whenever you look at any potential investment, because this is your capital and you want to preserve and grow your capital, obviously. So why wouldn't you apply that same level of skepticism that you would to other things to your investments? But that's just my point. But anyways, Fabio, let's kind of get back to the task at
Yeah,
hand
let's
here.
get back to Discovery. So
Yes.
what's
Yes.
going on with Discovery? Everyone's probably thinking, okay, when are they going to talk about the merger? Let's talk about the merger. All right.
Let's talk about the merger, Fabio. So basically, my first and foremost question is just sort of what are some of the grand implications of what this merger could have, both in the bullish thesis and then the bearish thesis as well.
Let's show you. So first of all, we can kind of let's actually not do that. It's just clicked. So here we are. This is where I want to be. I don't want to go to Cartoon Network. I kind of wanted to show us this. All right.
Yeah.
But that we turn into a live stream of Cartoon Network shows.
Yeah.
Okay, so
you're investing in a Cartoon Network if you buy this.
That's it.
Not true.
That's the only ask. But
yeah,
if this goes through, these are some of the brands that they'll acquire from Warner Media. And Warner Media is a huge company. So here's some of the things that's going on. So AT&T, this is the timeline. AT&T acquires Warner Media back a couple years ago, right? And I remember when it was happening, I actually liked the strategy that AT&T was employing. I thought it was interesting. The problem is they didn't execute and they're not consistent. And now, and that's a separate argument, there's not an AT&T video. Now they're divesting it, right? They're divesting it along with some debt and they're putting it onto Discovery. And Discovery is going to be a hyper-focused company where it just focuses on media and content delivery. Now, the problem was AT&T was thinking it in this way. They acquired DirecTV for who knows why. I have no idea why, but they did. And they bought it for way more than it was really worth. And now they're selling it for a lot less. And then Warner Media, they bought it for a lot of money. And now they're divesting it for a valuation that is quite a bit less. Not too much less, but quite a bit less. Not as bad as the DirecTV one. The DirecTV was a blender. But the one I actually liked was the Warner Media purchase because I thought they could leverage the media segment of their business and then kind of say, hey, you're subscribed to Verizon. I made the switch, actually. I made the switch from AT&T to, from Verizon to AT&T because of that, because I got HBO Max included, right? I got HBO Max included, all this content kind of bundled and went for the same price. So I looked at the two prices I was paying. So I was paying the higher end of Verizon. And then I looked at the higher end of AT&T and I was like, okay, if I pay the same, I'll get all of this other stuff. So I went with AT&T and I got basically like the same cards. I didn't really experience any difference. Okay, so with that, now they're divesting it. So now that's over. And AT&T, if you didn't tell, I don't like the company, I don't like the management, etc. But that's a side note, just there. All right, so these are the assets you're kind of looking at. And the one I value the most is HBO Max. I think that's the most valuable. Warner Brothers Entertainment Media. I like that because of the movies that they're going to be providing. The movies are going to go onto the box office and simultaneously HBO Max. So they're switching out the way that they're doing it starting next year. Because right now, Austin can attest to this. We come over to the theater and then we watch some of the movies. We watch Dune, fantastic movie, by the way, side note.
I still haven't seen it, man.
Yeah, he hasn't seen it. Yeah, he had a gig that night. But
so don't spoil it.
I'm not going to spoil it. I'm just going to say it's a
Yeah.
good movie. We're not going to talk about movies here. But anyway, some of that content really actually made me very, I wouldn't say bullish per se, but like very excited about this business or excited where they're going with some of their IP. However, DC, let's be honest, they've butchered a lot of it. Okay. So they butchered DC. I don't think I like DC. I like Marvel, but I like DC just a little bit more. And if we're being honest, they have completely and utterly butchered some of the IP there. So they need to fix that and kind of figure out what it is that they're doing with that. Like, I think Aquaman was pretty good, but I didn't like the original Justice League. The Snyder cut was better. Anyway, so some of the things we have here, we have CNN. Everyone knows CNN, good or for worse. For good or for worse, they have CNN. They have CNN Espanol. I don't know many of these other ones. I don't really watch TNT, but I know a lot of people do. HLN, the sister network of CNN, less popular. I don't know many of these other ones, but the point is you're getting a huge media conglomerate. And I think the majority of the value lies in that HBO Max. So now comes the question of together, what does that mean? And that's what we have to think about. What does that mean when you combine these two entities together? And some of the brands that Austin was talking about, they focus on a different type of TV. So a lot of documentaries, a lot of reality TV, more focused on the reality TV than anything. And all of that comes together with this other media segment. And now we have a true media conglomerate, right? So
Mhm.
again, going back to the IP and the moat, this is going to give them a really big moat, in my opinion, right?
Yes.
And I want to see, this is my concern. This is actually where I'm going to start to mention concerns, because so far I've just been talking about good things. Now let's talk about some negative things. So my concern with them is how they're going to handle having Discovery Plus and HBO Max. That's what I'm going to be watching, and then see if they can successfully merge them into one. Because me as a consumer, I don't really want, sometimes too many options can be confusing. And I know that sounds like, oh, it's not that confusing. It's two options. It's like, really though, but
It's
like,
expensive.
it's
Yeah.
not that it's expensive. If they put it
Yeah.
together into one, maybe they could say, you pay this one, you get access. You see, like, I don't know how they're going to handle it. It's not my job.
Yeah.
That's not my job.
Yeah.
But I want to observe and kind of see if it works out, because Netflix is so simple. I have Netflix, done, Netflix, right? And I have everything Netflix makes. And then right now with HBO, I have HBO. I have everything HBO makes and Warner Media and all that. But when they have Discovery Plus and HBO, I want to see what they do with that. I think even, well, you see, here's the confusion. Adult Swim has its own app, and Adult Swim is kind of like separate, where you can subscribe to Adult Swim. It's pretty weird. I think it's pretty niche, and their app is pretty terrible on my Fire TV. That's kind of like a side note. So it's not really optimized. So I want to see kind of improvements in consolidation in that, because I wanted them to make it simpler for the consumer. Because if it's kind of difficult for me, or not difficult, but like weird and awkward for me, I can only imagine for other people how awkward and weird it can be. And I kind of want access to all that IP, because they have wonderful IP. They just got to make it so that it's in a platform where I'm going to say, wow, I'm going to subscribe to that, because I want access to all of that content that I like, which Netflix
Yeah.
is figuring out. It's so simple, so intuitive. Same with Disney Plus, very simple. Of course, Disney's also kind of weird. So they're kind of going with the same thing. I'm kind of ranting here a little bit, but they have Hulu, right? Disney also owns Hulu. And they have Disney Plus, and they have ESPN. So they're separating into these different streaming platforms or content platforms.
Well, and that also kind of goes back to what I said earlier, where it can kind of get expensive, and it kind of turns into what I like to call a war for your wallet, where it's like, if you don't find that way to sort of successfully merge them into one, like the consumer now has all these different choices of where they need, or where they want to pay. And that could potentially, in essence, almost kind of degrade the market. So I would probably say the same thing, Fabio, that I would really actually want to see sort of an initiative between the two of them when the merger does, or if it doesn't, but hopefully it does go through. I would kind of want to see an initiative where they sort of, do that together, because then I actually think that with the quality of the brands that Time Warner actually owns, Harry Potter, like everything, I think that could be huge, Fabio. I think this could be a pretty incredible buying opportunity if management executes on this correctly.
Yeah,
And
yeah,
so,
the IP is fantastic. That's no questions about that.
oh yeah. And another question that I kind of have, and it's actually a question that my brother raised to me. Because right now they have multiple series of common stock. He was wondering that when at the conclusion of this merger, when they merge all those together, which they've indicated that they're going to do, he was wondering if that's going to, as he put it, dilute the heck out of him. So now I kind of want to pick your brain and kind of see what your thoughts on this might be.
Yeah. So right off the top, when I looked at the numbers, and this would be probably for a DD video to actually calculate the numbers, but just like my mental math, when I was looking at the how everything's going to be divvied up, it's basically the AT&T shareholders are getting the short end of the stick, and the Discovery shareholders are not necessarily getting the short end of the stick. They're just new to the party, but AT&T shareholders are towards the end of the party, and they're feeling kind of sick, kind of thing.
Yeah.
Because they
Yeah.
purchased it for a lot more than what they're divesting it at, right? And presumably there's some divestment of debt alongside that. So AT&T is taking quite a bit of debt off of the balance sheet, and that's supposed to going to help them, because AT&T does have a lot of debt, if we're being honest. So when we're looking at the new entity, it's going to, no, the short answer is no. It's not going to divest the heck out of him. If anything,
Dilute
dilute.
the heck out
Sorry,
of him.
dilute.
Yeah.
I've been saying divest a lot. So,
Yeah. Well, I mean,
so
the words are similar, so
very
it happens sometimes.
so he's going to, if he were to purchase the stock through Discovery, he's going to actually be, you could say, more levered, because the amount of debt that went into merging these two businesses is greater. So the leverage is going to be greater from the Discovery perspective, and owning the AT&T will be less leveraged, but potential less upside, because you are getting a smaller proportion of the business. So it can be kind of confusing, but what that basically means is, by AT&T taking off this debt off their balance sheet, the one who's taking on the leverage per se in the acquisition by percentage is the Discovery shareholder. But the Discovery shareholder will have more of the upside, because they're getting a greater proportion relative to what AT&T ended up buying it for in the past, and then what they're divesting for it now. And then the AT&T shareholder is benefiting supposedly from the debt divestment into the new entity. And so they're, technically speaking, the less leveraged in this transaction. So there's no, it's not about dilution per se, but you got to think of it in those terms. So the Discovery one, you're going to not have the AT&T entity, because AT&T will have, it will be like a split. You'll have T stock, and you'll have the new entity given to you through a reverse Morris trust.
Yes.
And that's, a fancy way of just doing what this is, basically. We won't get into that in this video. That'd be very long, but
yeah,
they do that for tax reasons. And what you got to think about is just simply who's taking on the debt. The new entity, AT&T, is divesting it, therefore the less leveraged of the two. So that does that answer that question? I mean, it's complicated. It's a long-winded
yes.
answer, but
No,
the short answer, no.
Yes, and that really actually helps kind of provide color to this situation as well. Now, I'm kind of also wondering too, what if this merger doesn't go through? What might we be looking at here? Because like the thing about investing is that you have to think about every potential avenue of where you could go wrong, and then where you could go right. Because if you just ignore the parts where you could go wrong, you could lose out on your capital, basically. And what we like to say here at Capital Mindset is that we like to preserve and grow our capital. A lot of people get obsessed with growing your capital, and they tend to kind of sleep on the preserving aspect of your capital. So now, Fabio, let's kind of explore sort of like an even more bearish thesis. Let's kind of say that this merger does not go through at all. The merger does not even happen at all. Mid-2022 comes around and everybody's like, nope, not happening. Let's kind of walk through this, especially kind of using the discounted cash flow model, show what Discovery is currently doing, as well as why the price has been kind of stagnating this entire year, and just kind of just walk through sort of the financial elements of this, and also why, even though in the discounted cash flow model, it might look like it's an incredible buy, which it might be. We might even determine that it is, Fabio. However, we also want to do bear in mind that there's some nuances to this business as to why the cash flows look so incredible right now. So
I actually wanted to cover this thing. So everyone probably knows what happened here, but for those who might not know, this was actually the death of a hedge fund, Archegos Capital. So Archegos Capital was leveraging the heck out of their position and just borrowing tons of money. Don't quote me, but I think they leveraged their portfolio about 10 times. Don't quote me on that number, but it was a lot. It was a significant amount. This hedge fund no longer exists. And they were one of the huge owners of Discovery, and they had to liquidate because of a margin call. And this was in a single day. It was this company and Viacom CBS. So Viacom CBS, the same event occurred, and we saw like a single day drop about 50%. And then it's been downtrending ever since. So somewhere around there, the announcement though was kind of being baked in. And the problem with sometimes these mergers is the market tends to stay away from these companies that are merging. Oftentimes it depends on the deal, let's be honest, but it depends on the deal. But a lot of times the market will say, kind of like a warning sign that it may be complicated or something's maybe iffy about it. It's not bad per se. It doesn't mean that it's bad, but it's something that just the market sometimes behaves in this way. And a lot of times, like with these spinoffs, like I can already tell you from UTX, United Technologies, they merged with Raytheon, and those were 3 home runs for me, 3 home runs in a row. And I bought Carrier, I bought Otis, and I bought Raytheon Technologies. And I bought them at the spinoff prices for Otis and Carrier. I'll let the audience go look at what happened. But basically, that's a case study, an example, a real world example for you to learn from as to when the market can be confused per se on a spinoff or a merger or anything like that. And the same thing happened with Raytheon Technologies. So Raytheon and United Technologies merged, right? And then when they did that, United Technologies spun off Otis and Carrier. So I purchased all three common stock entities after the fact when I saw that the market was kind of mispricing them. And I thought my thesis was that the market was fundamentally misunderstanding these three entities, and they were going to eventually be not mispriced because of the strength of each core business. So Carrier and Otis being very powerful brands. And Otis actually has a lot of recurring revenues. People don't understand that about Otis, but a lot of maintenance revenues. So, but my point with that is the market can sometimes misunderstand these things and you can take advantage of them. This may or may not be one of those. That would require a lot of research. But just looking at this, this seems to be a classic case of it's a kind of like a wait and see. I do not expect this company to begin to move up until there's more color or more information about what it's going to look like post-acquisition or even after the acquisition. Same thing happened, for example, with another company that I purchased in 2019-ish, or 2019, it was AbbVie. So AbbVie, it was the acquisition of Allergan, and they weren't moving until the acquisition, finished. And once the acquisition finished, things kind of became more clear, and then the company eventually recovered to where it currently sits today. And now I'm out of that one, by the way, so don't ask. But I'm out of that one. I took my profits. But what I'm saying with all those case studies is this is what we could be looking at. So what everyone's been kind of waiting for probably is the actual valuations. Yes. And let's go ahead, and we're looking at DISCA. So here's the caveat everyone should be aware of. This market cap is going to be taking into account just the shares, the class of shares that we're talking about, DISCA. The EV, though, is what you can actually look at. All right, the enterprise value. Enterprise value is accurate. So I'll pull up, for example, Seeking Alpha's data on the total market cap, and it should be accurate. So it's about 16 billion.
Fabio, again, would you just kind of briefly explain what enterprise value is for maybe some of our new viewers here today, and why there's such a discrepancy here, like I was talking about earlier in regards to the balance sheet?
Yep. So and scratch that about the EV being accurate. The EV is actually not accurate, but the EV is taking into account the EV or enterprise value of DISCA, but because it has so many different common stock, the model's not taking all that into account. So we're not actually going to be looking at market cap and enterprise value. But enterprise value, for those who may not know, is the market cap, and you're subtracting out the cash and adding the debt. So basically, well, I won't get into EBITDA. This is not a video for that, but we need to make a video on EBITDA and what the intended purpose of EBITDA was and how that's misused today by the financial media. Anyway, so enterprise value, that's what that means. And basically you can think of it is the purchase price of a company when you want to pay off all the debt, and the cash is not going to be yours. It's going to be given to the owners. So it's one way of looking at it. All right. So right off the bat, let's what's required rate of return do you have in mind, Austin, as you've been accumulating the knowledge for Discover?
20%. I'd like 20%? My 100% margin of safety.
Okay, so we have 20%. They have share dilutions if people were looking down over here, averaged out about 4% over the past couple years.
So I would just say, for the sake of this example, Fabio, I would say yes to the buybacks. Assume a 2% dilution, just for the sake of conservatism here.
They're not paying a dividend, so we're not going to be reinvesting any dividends. So just a negative 2%. So
and then the growth rates in cash flows for the first one, -2.
All right, -2.
-4.
All right, -4.
-10.
-10.
Just for the sake of this, -15.
-15. And I can already tell you, Austin, so this is where human minds have to come in, and sometimes why technology can fail. This discount rate must be 40%. And I'll explain that. Do you want to guess why that has to be 40%?
I would probably say because of the fact, actually, I'm kind of curious. I was just going to say something just for the sake of saying it, but I'm actually like a little like, I'd like to actually hear why that really is, Fabio. Because at least where my mind goes with this is because of the fact that the stock looks so cheap itself, that 20% isn't exactly indicative of a realistic rate of return, honestly.
Here it's not even that. It's we have to play around a little bit with the math, just because the way the model is kind of like scanning everything. But basically, this is where the human minds can kind of go beyond the model. And 40% is like a minimum. It actually needs to be higher. But the reason why, and why it can be a little confusing, is the model is actually taking into account the entirety of the cash flows and not separating it based on the shares that you own. Okay, so you're taking the full cash flows from Discovery, but not take into account that you own X class of stock that only has X amount of economic interest. So for example, the way you can kind of do it, and I know off the top of my head, I think they all have equal economic interest. You have about 1/4 of the company, just about 1/4 of the company, roughly, because it's a $4 billion market cap off of a true market cap of about $16 billion, you have 1/4. So basically, if you're being fair, this discount rate, this is 40%, is quite low. You actually have to multiply it by 4. So a true 20% discount rate is going to be about 80%. And you're obviously implying decay. So
okay, so then that kind of completely changes, because my initial thoughts, and as most of you should probably know, I'm rather new to investing myself. I am an accountant, but I kind of came over to the investing side a couple of months ago. My initial thoughts with this, actually, Fabio, and this is a very important just learning lesson for the audience as well. My initial thoughts were that they were creating a cash buffer to basically continue their strategy of where they're buying IPs, basically using that cash. So that's what I thought I was looking at here in case of this DCF model. But now kind of the story's really changed, if I'm being honest with you.
So this is what we can do for the audience. This is all real time, by the way. We're not hiding.
Yeah, no, this is like, so this is raw.
This is for everyone to see kind of our thought process. So basically what we can do is we can take the 2,500. So 2000, we're doing some rough math here, and then divide that by 4, and then we get something real. And then this is basically 352.
Take that,
so
divide that by 4. Yeah.
Yep, you get the picture. It's pretty rough math, but it kind of works out to be about the same, because it's just a preliminary analysis. So this is kind of what's attributable to what we're actually buying in the DISCA. And now we can actually discount at 20%. You see how we can no longer assume decay. We actually do have to start assuming some growth. And now things make a lot of sense. So this is why. It
does.
Oh,
yeah.
That's not a real number. Miles like, what are you talking about?
Hold on. Yeah. That's
5.
not a real number either.
No. It's 5, which is 500% per year.
Yeah.
There we go. And then perfect. 6, and then let's do a 10. So basically, and you have this. So like, let's not assume dilution anymore. Let's say they're not going to dilute us anymore. So now you can kind of see what's going on. So 10% per year, if they merge with Time Warner, that's pretty doable. I think. I don't know. I think that's pretty doable. Netflix is growing faster, but that's Netflix, but they're still growing faster. There's a lot of potential in growing outside of the United States, but maybe 20% required rate of return is maybe too aggressive. But you see, like now we're seeing a little bit of the color as to what was going on in the numbers, and that's just something that an investor over time you'll just pick up. So for those watching, like I was looking at this and immediately my brain was like, oh, all right, so that's something going on. And what gave this off is the market cap, right off the bat. So a good investor is going to derive a story from the numbers. The numbers are going to be speaking to me in a way. kind of like I'm hallucinating and I'm hearing voices. No, I'm just kidding. But I'm looking at these numbers and they're telling me a story, and then I'm gonna go and look at what is it that's going on relative to what I can observe. And right off the bat, I saw a market cap of 4 billion. I was like, there's no way. And then I cross-referenced it with other data, and yes, fair enough. And I knew already they had multiple classes of stock. So that just confirms that we have to make certain adjustments. Sometimes we'll have adjustments automatically made, like it did in Rocket Mortgage. Rocket Mortgage, the adjustments were automatic, and that's fine. But sometimes, again, these financial instruments can be quite confusing. And with Discovery, you can be misled by that. So still, the investment still looks pretty good. Look at that 15% rate of return. Look, I can assume a 3%. I can't have dilution though. Let's dilute us. Yeah, you see, if I have dilution, I can't assume that.
Then you need to start assuming 6%.
Yeah,
but that actually makes perfect sense to me, Fabio. It's almost like multiple classes of stock, exceptionally, or at least the nuance of having a low market cap. There's a little bit of a smell test there. There's a little bit of a fishy scent there.
Yes,
and
yeah,
so you should do more
it.
DD into there. Okay.
Yeah.
Wow.
And
well, I mean, like, hey guys, this is completely raw. So as I'm sitting here, I'm actually learning something new, which is pretty incredible. So
yeah, so
but
I would say, if I'd watch management say, okay, are you guys going to dilute me more? Because to answer CJ, it's not from the merger, it's just from management. Management just, diluting you. Let's actually take a look here at the data dump section, and let's see where the common shares have been going over time. So right here, okay, so I see what happened. All right, so it's not actually dilution. So you see, this is why you have to do further investigation. We're just doing a preliminary here, but I'm just going to do some further investigation. I say, okay, they diluted us a little bit, not a little bit, but a decent amount. Something happened there, but then over time, they kind of brought back down a little bit. So I'm going to take over the more recent behavior, and let's assume they do that going forward, because as a CFO, I would definitely not be issuing shares at current prices to fund investments. Definitely not. I think that it's cheaper to issue debt.
And actually, that also explains their statement of cash flows too. If you go to data dump, I bet you'll
You
probably
see, I didn't even look. I'm just letting the numbers tell me the story. That's it. That's all I'm doing.
Yep.
And then if I don't see that, then I start to I have disagreements with the CFO. All right. So, oh yeah, debt issued. Short-term debt issued. Is that what you're talking about? Or the long-term debt issued here? Yep, 2 years.
Long-term debt. Yeah.
Yeah, right there.
Long-term debt issued.
All right. So yeah,
Yep.
exactly. Yeah, I would be issuing debt. I would totally not be issuing shares. Issuing shares would be a mistake, in my opinion, and I would take that off their report card. Key ratios, we have to be, we don't want to make this video too long. And Austin, can you put timestamps on this video for everyone?
Oh, of course.
because the beginning part was kind of like the nuggets of knowledge, and not everyone maybe wants to see that all the time, but
yeah,
I'll be there for everyone who wants it. All right. So anyway, we want to look at improvements. So quickly, current ratio. No, it's improving. Ignores 2017. That's definitely a weird year. Something's going on there. They probably had a lot of cash from a sale or a lot of debt they issued. I'd more argue that probably the sale, maybe they issued. Oh, that actually, wait, that's probably where this bunch of stock came in. Yeah, so something happened in 2017, and I guarantee you it's the right there, an increase. They got a bunch of cash there. So 2017, from 2018 to 2017, there was a huge change in common stock. So I'm going to maybe assume from there that they got a bunch of cash during that year. And then the 2018 number of common stock was higher, and they probably used it to do something, probably an acquisition or something. That's what the numbers are telling me. But I'll take it from 2018 to 2021, improvements. This improved, all of it improved. Cool. And gross profit margins going to be really high because it's IP. They don't have to pay again to make the same documentary. They already made the documentary. It's done. Operating margins, I'll ignore 2021, but it looks like from 24 to 25, it's pretty good, stable. Net profit margin improving, awesome. 2017 is probably a fluke year. And so let's actually just, I don't want to say 2019 is a fluke year, but that's GAAP accounting. So maybe there's something wrong with GAAP. We'll see that in the next metric, which is our earnings quality. All right, earnings quality is all over the place, if we're being honest.
Yeah.
Here it's maybe bad, but I hope they keep it back over here. But typically it's good. They have a negative here, but GAAP net income. So ignore that. But yeah, we don't want to see this continue going forward. Then activity ratios, do they matter for this?
No.
No, not at all.
Yeah, no.
They're not selling us
yeah,
inventory.
they have like no inventory. Yeah.
So in summary, Austin, now that we've kind of normalized the numbers, because now we figured out, okay, that's what's going on. And so everyone can recap how I figured that out. It's basically, I looked at the market cap, saw that someone's wrong. Immediately the numbers are telling me a story. They're like saying, hey, look over here, adjust something. And we went and adjusted it, and we did just some quick math, just adjusted it based on the market cap. That's not the best way or the most accurate way, but this is the preliminary analysis. And so in that way, we kind of figured out these are our buy prices. I'll tell you this much. I actually don't think they're going to dilute you or dilute me if I buy. So I'm comfortable with saying no on the dilution. And let's actually go back to the 20. Can I assume? No, I cannot. So for me, if I could get this below 20, that would be fantastic. However, I actually do think at current prices, I might be tempted to add. I might be tempted to add this position into my portfolio simply because I think with the Time Warner acquisition, what I'll do is this is my plan. All right. If I like what I see going forward, I'm going to put this in my portfolio and I'm going to trickle in here and there. I'll do another video, or we'll do another video and kind of an update if I did add it. And basically that video will go into detail as to my allocation strategy, which if who I ever speak to about stocks knows that I always harp in on the most difficult part is not deciding to buy a stock. It's actually the allocation. And this is the last, I guess, nugget of points of view from I guess from my end in this video.
I was just about to ask.
What?
So I was just about to ask about your allocation strategy if you were to buy into this.
Oh, I thought you were saying, oh, another opinion.
Oh, no. I love the Fabio nuggets of knowledge. It's wonderful. I learned so much. No, like actually, like literally, I love it.
Well,
so
for this one, it's basically, it is the most difficult part, deciding how much to put into a stock after deciding that it's a buy for you. Like, not only is that difficult for most people, but I guarantee you the most difficult thing because basically even no matter how much you do the research, you could be wrong. You could just be wrong. So allocation and understanding risk management is very important. And so that's what can make or break your portfolio. So for example, for this one, off the top of my head, rough estimation, based on the current status of the merger, I would say it cannot be more than 5%. Yeah.
Interesting. And why is that, Fabio?
Well, because I think they could actually hit those growth numbers. But my preliminary predictions are kind of focused on that merger going through. I think together, all the IP under one umbrella, they could hit those growth numbers. They could definitely hit like 10%. I think so. Because you'll have the synergies, you'll have perhaps a better credit rating because they're going to have a lot more IP, a lot more staying power, a lot more value there. So perhaps that's going to occur, but I'd say more on the synergies. And then they can make a better compelling case for new subscribers. They can say, look, subscribe to our platform, look at all the content we have. So in this case, it is an IPs game. Disney figured that out. Netflix figured that out. This is an IP game. Whoever has the most IP and the compelling IP. So,
and we could be seeing here Discovery and Time Warner figuring it out too. So,
yeah. So here's the problem. So like, for example, if my risks are not manifesting, my 5% allocation is going to seem silly. because it's going to say my max 5%. Like that's my max. Okay. And I'm giving that as a rough estimate. It might be lower than that. But my max allocation is maybe going to be 5%. So I'm going to trinkle here and there, hoping it comes down more. Again, I would be very comfortable with, I think it was, yeah, if I get it at 17, that I'd be very comfortable with that price. That one, I could say that's when I would add heavier, but keeping it at that 5%. And that would probably, if it gets down to 17, that it would probably reach my 5%, because I said it might be lower than that, but that's because of maybe current prices. But like if it got to 17, I'd probably hit it at 5% pretty aggressively. And then after the merger, I would look at this again, basically reevaluate it and say, look at kind of what management's planning on doing. And if I agree with it, it could go higher and then maybe up to 10%. But I'd have to see what happens after and then it goes through. So that's basically why it's limited. And you can kind of see, I'm thinking almost kind of like the market, it's like the market's kind of a wait and see. It's not going to really do much until the merger closes, probably, because a lot of investors are thinking the same, the wisdom of the crowds, or efficient market hypothesis, which is kind of bullcrap, but
that's for a different video.
different video.
Yes.
But yeah, that's basically where I'm at. I like it. I actually like it. Austin, what are your thoughts? Do you like it?
So this is actually currently a position in my portfolio right now, and I'm actually like pretty bullish on this merger. And I have it at like a pretty substantial amount. I'm aware that there's risks inherent in this, but also it's not so much so to the point where if this merger doesn't go through and all those risks manifest, it's not like I'll lose a ton of money or like I'll lose like a ton of my portfolio size. So I'm actually pretty excited about this, Fabio. I'm probably going to continue to build my position in it now. I think prices are probably pretty good. And I actually have a very strong feeling that that exactly what we were talking about earlier, where Time Warner and Discovery, I actually do think that they're going to reach a pretty sizable convergence. And I actually think that it will potentially rival Disney and Netflix. Now, I might just sound like a complete hype YouTuber, but that's just my personal opinions regarding this. So I'm going to keep actually building my position in this company as well.
But will it 10x though?
I can't say that for certain. As we've said, every single time we have a bone to pick with people that are like, oh, this is going to 10x. This is going to like 20x in 2 days. Fabio, I saw a video title like that. It was like, this stock is going to 20x in like a month. And I was like, but anyways, that's either here nor there. That's not the purpose of this video.
You're not a believer?
Keeping this. No, I guess.
Are you spreading FUD on the internet again, Austin? How many times? How many times do I have to tell you?
Yes, I know. I'm guilty of it, Fabio. I'm very guilty of it. But
all right, so you kind of heard it from us, guys. That's kind of our broad-based opinion on the preliminary analysis. Austin's bullish. He's got thumbs up. I am not bullish, but not mega bullish. I'm kind of like bullish,
like you're like skeptically.
I'm skeptically healthily skeptically bullish, right?
Yes.
With
optimistically bearish.
Optimistically bearish. Okay, that's a new. Okay, you know what? That's a rating we're gonna give now. Optimistically bearish. Like that's an official rating from Capital Mindset. Which, by the way, we're gonna be restructuring our articles because this is another thing. This is the last closing comment. If you're done with the video and you came what you wanted to see with Discovery, you're good. This is it. We're not gonna be talking about Discovery anymore. The last bit of this video is basically new format for the articles. We're going to try to make them simpler because, we're not giving you massive research reports. We're just going to basically give you straight to the point opinions about what we see in a stock, basically. And it's going to be very quick. Makes it easy for us to write it because we have things that we need to get through during the day, and also makes it a very easy read for you guys. And then hopefully it accompanies with a video. It seems that all our videos are ending up being like 30 minutes at minimum, even on our preliminary videos. So
yeah, I actually think people come specifically to see these because, Fabio, me and you dedicate hours upon hours to these these shows. And so I like it.
And it's fun. It's fun for us.
It's very fun.
That's going to be the article format when you want a company, or you go to the website and you can kind of see like a quick synopsis. Sometimes it will have things that we didn't mention in the video. Sometimes it won't. It literally will just depend. It's basically serving as a written archive of sorts for different stocks and stock analysis. It's going to be like, quick summary overview of the business, mode analysis, anything that stuck out in the management team. If it didn't stick out, we won't say anything about it. And then just the financial analysis, and then prices that we would be considering at, and then allocation analysis, which is the hardest part. But sometimes we won't even say if we're not going to interested at all, we won't say that. All right, so that's basically it, everyone. Thank you guys for watching. If you guys have any requests, you guys can leave it in the comment section below, but it's better if you guys go on our website at capitalmindset.org, and I will actually pull that up. Because it basically sends us both an email, and that's actually how we can better see your comments, or not comments, requests. We do our best to reply to all the comments. And again, from what we said in the beginning of the video, we're very proud of the comments we receive on our channel. We think actually it shows the quality of our viewership. But if you go here, you don't have to put your real name. It doesn't really matter. What matters is the request. But if you want to give us your real name, that's fine. And then, yeah, just give us a little bit about the company, and then we'll do our best to get that in time. We still have a list, a pretty long list, because you guys have been quite active here. It's pretty
awesome. Yeah,
I think
it's absolutely awesome, and we're very, very thankful for it too. So thank you guys so much for sending our inbox with a lot of these stock requests. We're really going to try to kind of work through them and get them out for you guys within the next coming month or so.
We have
couple
12,
weeks.
12 more new ones.
12? Wow. Okay, cool.
Yeah.
Nice.
So, but that's neither here or there. We have a lot of content to push out there, man.
We do.
We have a lot of content on the backlog too, but yep. So thank you guys. If you guys really like the video, please feel free to leave that like button. That really helps us. Comment. And then again, we're still a small channel, so we're getting really good at commenting back. Sometimes, maybe we can't do it the same day, but we get there. And feel free to subscribe for more content, because we're going to do more stock analysis going forward. Again, you just heard we have 12 new requests, and we are getting through all of them. Don't worry. Even the ones where you guys sent us an email saying, oh, I know this is a lot of them. It's like, no, we're going to do all of them. So don't worry.
All of them.
All of them, every single one.
And we're
until
holding ourselves to task. Yes.
At some point, when this channel is at a certain size, we won't be able to do all of them, but we'll do like a polling at that point. But in the beginning, now we're going to be doing all of them. So thank you guys so much for watching, and we'll see you on the next one.
Take care.